Alexo Crypto here. Shout out to you guys. Shout out to the Auto Gang. We got Jerome here. Let me know if I need to turn this up. Price stability. Bitcoin's dropping right now. Bitcoin's falling. Ooh. The labor market is tight. Oh, Bitcoin's coming back up. Oh, it's coming back up. I'm Jerome. We're going back down. A long way. Are they going to ask him about the banks? Let's find out. We're crashing. Are we going to crash? Oof. Oof. Yellow X's. Yellow X's. Hope you're all doing well. Thank you so much for being here. Key level support. Coming up to a key level of support. Woo-hoo. Go over, say hi, Frankie Candles. Don't forget to like his video. This is the guy. How they unfold, my friends. Hope you're all doing well. Well anchored, my friends. Don't add a W in front of the word anchored, okay, whatever you do. Maximum employment. Ooh, price is coming back up slowly here. Back up to 27. Let's zoom in. I can't even see this. This is a bit weak sauce here. Ooh. Are you prepared to pause? Here's the big question. Are you prepared to pause? Keep your paws off the goods. We like you, Jerome. No decision. No decision on a pause. We're coming back up. Ooh-wee. Coming up to resistance. Not prepared to pause. Modest rate. Modest rate. This is healthy. Oh yeah, that's good, eh? The market's saying it's better. We got a pump show here. We're coming up. We're coming up. Good morning to everybody. Thank you so much for being here. I appreciate every single one of you. Oh. Thank you, Chair Powell. Thank you. Thank you very much. Raise the ceiling. This has nothing to do with me. Leave me alone, he's saying. Please leave me alone. It's essential. They they need to pay all their bills. So they must raise the debt ceiling, is what they're saying. Otherwise, they're screwed. In conclusion, raise the debt ceiling or you're screwed. Make sure to go say hi to Frankie Candles here. No. Bitcoin's kind of sting in the middle here. Oh, we're coming back down. So they've grabbed liquidations here. They've grabbed the shorts. Short squeeze, possibly. Short squeeze. One move. Remember, we always talk about this one move. Oh, now can we head down? Looking like we're getting a little push down. We're talking about banks. We like hard questions here. We like hard questions. Thank you. He didn't remember it. Jerome's such a legend. Look at him, just handling the heat. Handling the heat, Mr. Jerome Powell here. 29,100 for a short, my friend. Let's look. Hope you're doing well, Nick. Can you hear? You can hear all right? Whew, that'd be at the top of the range. Look at that. I got it marked out, my man. He knows how to play dodgeball. Yeah, man, I like that. I like that for sure. You can see here if we zoom out. We zoom out. We got this wedge, right? Everybody's talking about this beautiful wedge. If we come up to the top of this wedge here, we're looking for a big move, right? We're looking for that come out and bow, right? But we could come up to the top of the wedge here and work our way back down. I do like that level, bro. That level looks good. Hope you're doing well, man. Look at this. If we can come up here, get rejected. The more this tightens, the bigger the pop, right? Look to see if we challenge this 29,100 golden pocket area. Mini range POC of the past range. Can definitely come up to this area. We'll watch it right now. Let's see where we at. Jerome's still dodging the dodge balls. He can dodge a wrench. He can dodge a ball. Looks like we're making higher lows here. Higher lows here. Could be possibly pushing up. We got a bit of a wick here. Let's see. Do we get any bullish divergence? Nothing yet. No bearish divergence either. Let's see the 24. Let's close this up. The things you wake up at 4 a.m. in the morning for, Nick, I tell you. It's good to have a range of different banks, especially Bitcoin banks, cryptocurrency banks. I'm not gonna say spank banks, but I just said spank banks. I'm sorry, I couldn't help myself. Oh man. This is a friendly, loving, kind channel. Don't get the message wrong. Don't shoot the messenger. It is 4 in the morning. Sometimes the mind's a little bit. Put on the Otter Gang hat. You have to follow the law. Yes, Jerome. We do like to follow, some sort of law, even though you're biggest crooks in the world. Financial Times, Colby. So far, nothing about cutting. We're looking for them to stop hiking rates. That's what we're looking for. That's what we're fishing for here. That will be very bullish. Oh, we got a blood diamond on the 1 minute. Sorry, 1 minute. Could be curling back down here. Higher lows. Honest and humble. Honest and humble. United States of America is honest and humble. This isn't a stand-up, is it? I've lived beside these guys my whole life in Canada. Can you hear? Can you hear Jerome all right there, Nick?
Just to quickly follow up, what does it suggest about the scope for the committee to pause rate increases perhaps as early as next month, even if the data remains strong, then if it's having some kind of substitute effect?
One dude in Norway has 400 kids. He is banned from the bank. This guy's spanking way too much. Don't do it to me. Maybe if I turn, I don't want to blow anybody's speakers. I'm going to turn.
See what's happening with credit conditions, what's happening with lending. There's a lot of data on that.
How's that?
We'll factor that into our decision.
Is that better?
Howard Schneider with Reuters. Thank you. So noting that the statement dropped the reference to sufficiently restrictive, I was wondering, given your baseline outlook, whether you feel this current rate of 5 to 5.25% is in fact sufficiently restrictive.
So that's going to be an ongoing assessment. We're going to need data to accumulate on that. not an assessment that we've made. That would mean we think we've reached that point, and I just think it's not possible to say that with confidence now. But nonetheless, you will know that the Summary of Economic
No
Projections for the March
confidence.
meeting
You think we have confidence in you?
at that point in time, that the median participant thought that this was the appropriate level of the ultimate high level of rates. We don't know that. We'll revisit that at the June meeting, and that's, we're just going to have to, before we really declare that, I think we're going to have to see data accumulating and make that, as I mentioned, it's an ongoing assessment.
A follow-up on credit, if I could. Could you give us a sense of what the SLUICE survey indicated? It was already, I think 45% of banks were tightening credit as of the last survey. What did this one show, and how did that weigh into your deliberations?
So we're going to release the results of the SLUICE on May 8th, in line with our usual time frame. And I would just say that the SLUICE is broadly consistent when you see it with how we and others have been thinking about the situation and what we're seeing from other sources. You will have seen the Beige Book and listened to the various earnings calls that indicate that mid-sized banks some of them have been tightening their lending standards. Banking data will show that lending has continued to grow, but the pace has been slowing really since the second half of last year.
Nick.
Pace will be slowing.
Nick Timmerouse of the Wall Street Journal.
There's more pain to come.
Around the end of last year and the beginning of this year to slow down the pace of increases was to give yourself time to study the effects of those moves. After the bank failures in March, as you've discussed, the Fed staff projected a recession starting later this year. So my question is why it was necessary to raise interest rates today, or put differently, if the whole point of slowing down the pace was to
Why
see the
would you
effects
do
of your
this?
moves, and now you've, for the last two meetings, been seeing the effects of those moves. Why did the committee feel it was necessary to keep moving?
Well, the reason is that we, again, with our monetary policy, we're trying to reach and then stay at for an extended period, a level of policy stance that's sufficiently restrictive to bring inflation down to 2% over time. And that's what we're trying to do with our tool. I think slowing down was the right move. I think it's enabled us to see more data, and it will continue to do so. So we really, we have to balance. We always have to balance the risk of not doing enough and not getting inflation under control against the risk of maybe slowing down economic activity too much. And we thought that this rate hike, along with the meaningful change in our policy statement, was the right way to balance that.
And just to follow
They
up,
printed way too much at COVID.
in response to
That's what
Howard's
they're
question,
saying.
You'll need data to accumulate
They're a
to
printing
determine
machine.
if this is a sufficiently
And people
restrictive
are
stance.
leaving the American dollar.
Does that data need to accumulate, or could it accumulate over a longer period than a 6-week intermeeting cycle?
As I mentioned, I would just say that this assessment will be an ongoing one. You can't
Ongoing.
with economic data.
What's
and
ongoing?
You can't. You've seen take inflation from it. Look back. We've seen inflation come down, move back up 2 or 3 times since March of 2021. We've seen inflation have a few months of coming down and then come right back up. So I think you're going to want to
Come down,
see
bounce up.
that.
Well, you've been bailing out the banks. What do you think's going to happen? You're printing more
that
money.
you've got this right, kind of thing. And we have the luxury. We've raised 500 basis points. I think that policy is tight. I think real rates are probably that you can calculate them many different ways, but one way is to look at the nominal rate and then subtract a reasonable estimate of let's say 1-year inflation, which might.
I'm
be
no
3%,
economist,
so you've got
but, you know,
2% real
printer
rates,
go
that's
brrr.
meaningfully above what most people would. Many people
Inflation
might
go
would-
up.
Would assess as the neutral rate. So policy is tight, and you see that in interest-sensitive activities, and you also begin to see it more and more in other activities. And if you put the credit tightening on top of that and the QT that's ongoing, I think you feel like we may not be far off or possibly even at that level.
possibly even at.
Chair Powell.
Ooh-wee.
Edward Lawrence with Fox Business.
Jerome, what are you saying?
So if the Federal Reserve gets down to the 3% inflation as the projections show at the end of this year or close to it, would it be okay for you for a prolonged period of 3% inflation and hoping for some outside event to move down to 2% target?
Look, I think we're always going to have 2% as our target. We're always going to be focusing on getting there.
Would you be okay with a prolonged 3%?
You know what? It's let me just say that's not what we're looking for. We're looking for inflation going down to 2% over time. I mean, that's not a question that's in front of us, and it would depend.
Over time, not by the end of the year. Over time.
We're looking to get to 3% and then drop our tools. We have a goal of getting to 2%. We think it's going to take some time. We don't think it'll be a smooth process, and you know, I think we're gonna need to stay at this for a while.
How does the other side of the mandate, the job side, once you get to 3%, going from 3 to 2, how does the other side of the mandate balance?
I think they will both matter equally at that point. Right now, you have a labor market that's still extraordinarily tight. You've still got 1.6 job openings, even with the lower job openings number, for every unemployed person. We do see some evidence of softening in labor market conditions, but overall, you're near a 50-year low in unemployment. Wages, you all will have seen the wage number from late last week, and it's whenever it was, and
He's just human, man.
percentage points above.
Hats go off to
what
you,
would be
Jerome. You're
consistent
trying your
with
best, man.
inflation over time. So we do see some.
He's
softening.
just
We see
dodging,
more supply coming in.
ducking.
These are very positive developments. But
He's doing his best. I mean, look at the job he's been given, man. He's just another human trying his best to do what he's told, but also balance this
Fortunately, we've been able
wild,
to do that
wild
so far
west.
without unemployment going up.
Good man, Jerome. You can do it.
Hi, Chair Powell. Matthew Boesler with Bloomberg News. So many analysts noted at the time of the March
Just say
FOMC
buy
meeting
Bitcoin.
that at least half of Fed officials' projections did imply or seem to imply that a recession was in their baseline forecast as well, given the strong first quarter GDP tracking estimates. And so I'm just wondering if you could kind of elaborate on, why you're optimistic that a recession can be avoided, given that that's the Fed staff's forecast, possibly also the broader committee's forecast as well, and also, of course, most private sector forecasters.
Yeah, I don't think, I know what's printed in the Summary of Economic Projections and all that. I don't think you can deduce exactly what you said about what participants think, because you don't know what they were thinking for first quarter GDP at that point. They could have been thinking about a fairly low number. Anyway, in any case, I'll just say I continue to think that it's possible that this time is really different. And the reason is there's just so much excess demand, really, in the labor market. It's interesting, as we've raised rates by 5 percentage points in 14 months, and the unemployment rate is 3.5%, pretty much where it was, even lower than where it was when we started. So job openings are still very, very high. We see by surveys and much evidence that conditions are cooling gradually, but it really is different. It wasn't supposed to be possible for job openings to decline by as much as they've declined.
It's very different. Very,
well, that's what
very different.
So there are no promises in this, but it just seems that to me that it's possible that we can continue to have a cooling in the labor market without having the big increases in unemployment that have gone with many, prior episodes. Now, that would be against history. I fully appreciate that. That would be against the pattern. But I do think that the situation in the labor market with so much excess demand, yet wages have been moving down. Wage increases have been moving down, and that's a good sign, down to more sustainable levels. So I think it's still possible. I think the case of avoiding a recession is, in my view, more likely than that of having a recession. But it's not that the case of having a recession is. I don't rule that out either. It's possible that we will have what I hope would be a mild
In
recession.
conclusion, he doesn't rule out anything.
Growth was still well above levels that would be consistent with 2% inflation. Do you see that as well? And could you kind of explain, how you come to that judgment?
Sure. So we look at a range of wage measures, and then that's a nominal, and then so you assume wages should be equal to
VWAP slapping us
productivity
down,
increases plus
doing
inflation.
its job.
And so
VWAP.
you can look at, the Employment Compensation Index, average hourly earnings, the Atlanta Wage Tracker, compensation per hour, basically those four, and many others, and you can look at what they would have to run at over a long period of time for that to be consistent with 2% inflation. They can deviate. Corporate margins can go up and down, and there is a feature of long expansions where they do go down, where labor gets a bigger share toward later in a recession. Later in expansion. So, yeah, and we calculate those, and you have to take the precision with a degree of salt. But I would say that what they will show is that, if wages are running at 5%, 3% is closer to where they need to be. Wage increases closer to 3%, roughly, is what it would take to be consistent with inflation over a longer period of time. By the way, I do not think that wages are the principal driver of inflation. You're asking me a very specific question. I think there are many things. I think wages and prices tend to move together, and it's very hard to say what's causing what. But I've never said that, that wages are really the principal driver, because I don't think that's really right.
Great. Chris Rugaber at Associated Press. Well, you mentioned profit margins.
Wages are not a principal
those have
driver, my
expanded,
friends.
did expand
Wages.
sharply during this inflationary period, and while there are some signs that they are starting to decline, many economists note they haven't fallen as much as might be expected, given that we're seeing at least some pullback among consumer spending. So, speaking of causes of inflation, do you see expanded profit margins as a driver of higher prices? And if so, would you expect them to narrow soon and contribute to reduced inflation in the coming months?
So higher profits and higher margins are what happens when you have an imbalance between supply and demand. Too much demand, not enough supply. And we've been in a situation in many parts of the economy where supply has been fixed or not flexible enough. And so, the way the market clears is through higher prices. So I think as goods pipelines have gotten, back to normal, so that we don't have the long waits and the shortages and that kind of thing, I think you will see inflation come down, and you'll see corporate margins coming down as a result of a return of full competition, where there's enough supply to meet demand, and then you're really back to full competition. That would be the dynamic I would expect.
Full competition. Let's compete.
Radio and television.
Once again.
Can you tell us something about what your policy reaction function is, your policy framework is going forward when you look at the economy at the next meeting? Are you
Good morning, Michael.
incoming data, which is by definition backward looking? Are you going to be forecasting what you think is going to happen? Are you ruling out the rate cuts that the market has priced in?
I didn't catch the last part. Ruling.
Markets have priced in rate cuts by the end of the year. Do you rule that out?
Okay, I got it. So what are we looking at? I mean, we look at a combination of data and forecasts. Of course, the whole idea is to create a good forecast based on what you see in the data. So we're always
Jerome Powell, the weatherman,
Of course,
creating
it'll be,
good
It'll
forecasts.
be readings on inflation. It'll be readings on wages. On
What does the
economic
weatherman
growth,
do so well?
on the labor market.
Weatherman lies.
All of those many things. I think a particular focus for us going.
I don't think so. I think
they
they don't realize how many people have had to pick up secondary jobs in order to pay for the cost of things. Eggs,
Small and medium-sized
rent.
banks, tightening credit standards, and is that having an effect?
They're cutting out the middleman.
On loans, on
Poor
loans?
and rich, that's it.
So we can begin to assess how that fits in with monetary policy. That'll be an important thing. I just, we'll be looking at everything. It's, again, I would just point out, we've raised rates by 5 percentage points. We are shrinking the balance sheet, and now we have credit conditions tightening, not just in the normal way, but perhaps a little bit more due to what's happened. And we have to factor all of that in and make our assessment of whether our policy stance is sufficiently restrictive. And we have to do that in a world where policy works with long and variable lags. So this is challenging, but we will make our best assessment, and that's what we'll be thinking.
What about the idea of rate cuts?
Yeah, so we on the committee have a view
That's the one, Nick.
That-
That's the one.
inflation is going to come down not so quickly.
They want dependence
It'll take some
on
time.
government,
And in
CBDCs, all that
world,
thing.
If that forecast is broadly right, it would not be appropriate to cut rates.
It's
and we
sad.
won't cut rates.
It's sad.
If you have a different forecast, and markets have been from time to time pricing in quite rapid reductions in inflation, we'd factor that in. But that's not our forecast. And of course, the history of the last 2 years has been very much that inflation moves down. Particularly now, if you look at non-housing services, it really hasn't moved much, and it's quite stable. And so we think we'll have to. Demand will have to weaken a little bit, and labor market conditions may have to soften a bit more to begin to see progress there. And again, in that world, it wouldn't be appropriate for us to cut rates.
Courtney?
Courtney Brown from Axios. I'm curious how you view the role of the overnight reverse repo facility in the context of the current banking stress. Do you think it's contributing to the stress by making it more attractive for money market funds to compete with banks for deposits? And did the committee discuss any changes to the structure of the facility, or do you see that being put on the table in the future? Thanks.
Sure. So we looked at that very carefully, as you would imagine, and it's really not contributing. We don't think now. It hasn't actually been growing. It moved up, moved down, and then moved back up to where it was. What happened in the when there were the big deposit flows, which by the way have really stabilized now. What happened was institutional investors took their uninsured deposits and put them in government money market funds, which bought paper from the Federal Home Loan Banks and things like that. Over the course of maybe the last year, retail investors had been gradually, as they do in every tightening cycle, they've been gradually moving their deposits into higher yielding places such as CDs and other things, including money market funds. So that's a gradual process that is quite natural and happens during a tightening cycle. What was unusual really was the institutional investors moving their uninsured deposits and spreading them around and things like that. But it doesn't seem to have had any effect overall on over the overnight repo facility. That is really there to help us keep rates where they're supposed to be, and it's serving that purpose very well.
Sarah Ewald-Weiss, CBS News. I want to go back to the debt ceiling for a moment. I know you talked about that in terms of fiscal policy, but can you just speak towards what the impact of a default would mean for Americans across the country, the markets, and borrowing?
Don't default the debt.
I would just say
it'd be
I
devastating.
don't really think we shouldn't even be talking about a world in which the U.S. doesn't pay its bills. It just shouldn't
talk
be a
about
thing.
it.
And again, I would just say no one should assume that the Fed can really protect the economy and the financial system and our reputation globally from the damage that such an event might inflict.
Scott?
Thanks, Mr. Chairman. Scott Horsley from NPR. In his report last week, Vice Chair Barr identified a couple of the factors that he thought contributed to the supervisory lapses at Silicon Valley Bank. A policy change in 2019 to exempt all but the biggest banks from strict scrutiny, and also what he called a
I really don't like this range. I don't know about
towards
you guys.
less aggressive oversight. You were here in 2019. Do you share that view, and what would it take to get the stronger oversight that you and he said in your release would be necessary?
So I didn't take part in creating the report or doing the work, but I have read it, of course, and I find it persuasive. I mean, I would say it this way: a large bank, not a very large bank, a large bank failed quite suddenly and unexpectedly in a way that
Quite suddenly.
contagion into the
See?
financial system.
You're breaking things, Jerome.
I think
Don't break your
the
toys.
only thing that I'm really focused on is to understand what went wrong, what happened, and identify what we need to do to address that. Some of that it may just have been technology evolving. We have to keep up with all that, but some of it may be our policies and supervisory and regulatory, whatever.
What went wrong? Come on, you guys are taking our money, investing it in things that aren't good for the economy,
I am accountable.
risking our money, and not being able to give it back to us. That's what your banks are doing, man. Our hard-earned money, you just go and gambling with it.
Thank you. Evan
I'm
Rosenberg,
sorry, but that's
M&I Market
BS.
Chair Powell, are we in the early stage or nearing the end stage of the banking turmoil among regional banks? And secondly, do you still have a bias to tighten rates? Is that what the statement is saying?
So, I guess I would say it this way. There were three large banks, really, from the very beginning, that were at the heart of the stress that we saw in early March, the severe period of stress. Those have now all been resolved, and all the depositors have been protected. I think that the resolution and sale of First Republic kind of draws a line under that period is an important step toward drawing a line under that period of severe stress, okay? I also think we are very focused on what's happening with credit availability, particularly with what you saw in the beige book, and you will see in the SLOOS is small and medium-sized, medium-sized.
All higher term time frames except for the daily, but the 2-day, 3-day, 4-day, 5-day still pointing down. Dailies in the middle. Stochastics, there's still room to the downside. It is curling up right now, so. But most long-term time frames are pointing down.
Going forward.
Thank you, Fed Chairman. Greg Robb from Market Watch. I just wondered if you've done any reflection on your own actions during this crisis and leading up to it over the last, since you've been Fed Chairman.
Jerome doesn't have time to do reflection, man.
You deferred to the Vice Chair for Supervision.
He's not reflecting. He's deflecting. He's deflecting questions, man.
Yeah, comments on that. Thank you.
Sure. So let me say, first of all, I've been chair of the board for 5+ years now, and I fully recognize that we made mistakes. I think we've learned some new things as well, and we need to do better. And as I mentioned, I thought the report was unflinching and appropriately so. I welcome it, and I agree with and will support those recommendations, and I do feel that I'm personally accountable to do what I can to foster measures that will.
Poor Jerome, man. At least he takes responsibility.
So, on the Vice Chair for Supervision,
unlike these banks.
The place to start is the statutory role, which is quite unusual. The Vice Chair, it says, shall develop policy recommendations for the board regarding supervision and regulation of depository institution companies, and shall oversee the supervision and regulation of such firms. So this is Congress establishing a 4-year term for someone else on the board, not the chair, as Vice Chair for Supervision, who really gets to set the agenda for supervision and regulation for the Board of Governors. Congress wanted that person to have political accountability for developing that agenda. So the way it works, the way it has worked in practice for me is I've had a good working relationship. I give my counsel my input privately, and I offer that, and I have good conversations, and I try to contribute constructively. I respect the authority that Congress has deferred on that person, including working with Vice Chair Barr and his predecessor. And I think that's the way it's supposed to work, and that's appropriate. I believe that's what the law requires, and but it isn't. I wouldn't say it's a matter of complete deference. It's more. I have a role in presenting my views and having an intelligent discussion about what's going on and why, and that's my input. But ultimately, that person does get to set the agenda and gets to take things to the Board of Governors, and really in supervision has sole authority.
Stuck in the middle. No decisive kind of action here.
Any regrets, or was there anything that
you could have taken this short here?
Maybe you regret now in light of what's happened.
I've had a few.
Nice 2% gain.
Sure.
Look for it to break this
who
trend
doesn't
line.
Look back and think that you could
Pop back up maybe.
Honestly,
Let's see.
You don't get to do that.
It's got to challenge that VWAP. It's keeping it down.
Control, as one of my great mentors used to always say, control the controllable. What we control now is make a fair assessment, learn the right lessons, figure out what the fixes are, and implement them. And I think that Vice Chair Barr's report is an excellent first step in that, but we've got to follow through.
Thank you all for your support.
Hi there, Megan Casale
Much
with
love to
Barron's.
every single one of you. God bless you all.
Pausing,
Hope you're having a
this meeting
wonderful
come up
day.
at all, and how
Thank you
seriously
for
was that considered?
joining
I'm
us
curious
with the
if you could give us
beautiful,
any color as
beautiful
to
Jerome
whether
Powell
there were
here.
any initial concerns
Otter
raising
gang.
once again, or what those discussions
Join us in the free
entailed.
Discord.
So support for the
Let's see how
for the
we
25
get
basis
on
point
here.
Rate increase was very strong across the board. I would say there are a number of people, and you'll see this in the minutes. I don't want to try to do the head count in real time, but people did talk about pausing, but not so much at this meeting. That there's a sense that we're much closer to the end of this than to the beginning. That as I mentioned, if you add up all the tightening that's going on through various channels, we feel like we're getting close or maybe even there. But that's going to be an ongoing assessment, and we're going to be looking at those factors that we listed in to determine whether there's more to do.
I'm curious too how to interpret that and the changes to the statement. Is the bar higher now to raise rates at the next meeting, or would a strong jobs report or inflation print be enough to push the
Total
Fed to
trying to move up.
I don't want to. I couldn't.
We got
really
render
say.
pumping.
I just think
Render could be
I
pumping.
think we've moved a long way fairly quickly, and I think we can afford to look at the data and make a careful assessment.
And we'll go to Nancy for the last question.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. You mentioned a few times about the lessons you learned from the banking crisis, that you would learn the right lessons. What are those lessons?
Well, I just would start with something that's changed, really, which is the run on Silicon Valley Bank was out of keeping with the speed of runs through history. And that now
Let's see if we can
needs
do
to be
it.
reflected
Can we
in
do it? Can we
some-
flip it?
in some
Can we flip
way
it and
in
pop up?
regulation and in supervision. We know now that we know it's possible. I think no one thought that was possible. No one had. I'm not aware of anybody thinking that this could happen quite so quickly. So I think that that will play through. It will be up to Vice Chair Barr to really take the lead in designing the ways to address that. But I think that's one thing. I guess I would just say that then that we're gonna revisit. It's pretty clear to me anyway. It's clear that we need to strengthen both supervision and regulations for banks of this
We're
size.
double dipping.
And I'm thinking that we're on track to do that as well.
Can you be any more specific on stress testing or looking at banks that have specific concentrations in certain parts of the economy?
Yeah, that's what Vice Chair Barr's role really is, and he'll take the lead on that.
Okay, thank you.
Thank you.
Well, Mr. Jerome Powell. Hope you're all doing well. What's up, Otter Gang? Hope you're doing well. Thank you so much for being here. Strag a heart in the chat. No massive moves, okay? No massive moves. We're drawing this out. We can see that we're stuck in the middle with you. Beautiful song. So we're going to look for a move here. We're going to wait and see. 5.25% expected. I think it was 90% expected. We're going to wait and see for a reaction here on the price, okay? No moves to be had. He did not say much at all. I agree with you there, Nick. My nose is running. I apologize. We are all human. We do get runny noses sometimes. But yeah, not much said. Not much said. So for me, this remains a lot of the same, right? What I look to happen is with this 5.25%, you know, we've hiked again. That's what's happened, okay? So nothing's changed. Banks are not going to be any better off, right? More people are going to flock to Bitcoin. Does that mean price is going to go up or down? I don't know. But in the long-term time frames, for me, long-term time frames are suggesting downwards action, okay? When you go over to these time frames and we look at the 2-day, we can see we're curling over, overbought on the stochastics, red dots on the 3-day, looking to print. Yeah, we had that little bit of a pushback, right? But overall, looking to curl down, okay? We can see also that we have a continuation here on the movement of the money flow. Money flow stayed high, but it does look to curl over, right? All this is pointing to the downside. We had that weekly red dot confirmed. Yes, we have a little bit of a curl back up here, so let's keep an eye on that as well on the weekly. The 5-day has flattened, so that's a sign of heading down, possibly for the weekly. The 2-week here is looking to curl over. That could continue. Okay, so the long-term time frames, in my opinion, are all pointing down. The daily is curled down, but money flow is in the green. Okay, very mixed signals. Stochastic pointing up. Very mixed signals on the daily. So we love you, Jerome. Thank you for sharing all your insights. We will continue to trade the charts. Shout out to you guys in the Discord. I mean, we're still here. We're making trades. We're doing all right. I mean, I had a nice scalp in and out. Took some profit, 37% yesterday. So we are here. We are going to continue to trade and conquer these charts together. I will be updating you guys on some price action and some thoughts. But simply draw the sandwich, okay? Draw the sandwich. We got 28.7 that we came up to and 27.8. Look at that. Vice versa. Vice versa, okay? That's lovely, okay? Vice versa, we have this sandwich that we're currently in. And then if we look at the bigger picture here, we're looking to print this massive head and shoulders pattern, okay? So we got this big signal. We got this wedge, okay? These are the things I'm watching right now. So we got this big signal, this wedge. We have key supports, okay? Key supports, if we get below 27,000 here, big trouble, okay? Big trouble. And as we get further along here, this trend line gets higher up, right? So 27.3 over here, so we're about 27,200, let's say, give or take, okay? We got the 3 beautiful head and shoulders, right? We have this descending wedge here, and look for this to pop. Now, if this does pop, a measure move from the top to the bottom here, if we put this in, we're coming back down. 23K, right? Maybe if we happen here, we only go to 25.2, which is a key level of support. But if we do pop up, we can get to those beautiful new all-time highs around 33,000, right? So we'll be watching this for a reaction. As we get further down this wedge, we can look for a much tighter and bigger pop, okay? So these are things I'm keeping an eye on for the long term. But for now, I trade the range, right? I stay within the guidelines. I don't complicate things too much. I just try to stay within this range. There's also this support line here. If you want to add it here, it's a bit higher, and it's held confluence throughout that we're looking to hold us up as well. So we'll be watching these things, but Jerome did not tell us much, okay? That was pretty a dodgeball event of Jerome dodging all the balls thrown at him. And, you know, he's doing his job, right? He's doing his job, but at the end of the day, he's hiked by 0.25%, and people are saying SHIB to the moon. Okay. So we're going SHIB to the moon. Stragahart, it's trading SHIB. Dollar index, it's come back to retest this downtrend. It could be looking, I think there was some sort of bearish divergence on the daily, was it? Anyways, dollar's come down. It's touched back down to this trend line, looking for a continuation upwards. It has not happened yet. So look for that too. If it continues downwards here, look for Bitcoin to pump, right? S&P, new highs, hasn't made it, okay? It's gotten rejected. So is it going to follow this downtrend into this recession that everybody's talking about, okay? We've been in a recession 2 months of negative GDP. That has happened, so be very careful here on what's going to happen. Jerome is just dodging questions, right? So now we get into this range. We make a very, very careful risk management decision on what to trade. And what do we trade right now? Nothing, because we're in the middle of the range, okay? We're in the middle of the range, and we're definitely looking. Dave Digital in the chat. How we all doing? Dale Edgecombe, TRD Farmer. Hope you're all doing well. Jerome just dodged, dipped, and ducked, you know? So now we're all in the middle of this range. Bitcoin dominance has dropped significantly. One thing to note is Bitcoin dominance has dropped significantly during this speech, okay? It is still very, very high, okay? It's still very, very high, up above 47%. We were looking at total 3 as well. It was having a bit of a pump, but it has yet come back down to reality. So the market cap is still healthy. We love Canada. We love the Toronto Maple Leafs. Thank you so much, Farmer. Roots. I think it's Roots. Yeah, it's Roots. We got Roots. Represent. Dodge, dip, dive, duck, dodge. So we in it to win it, as per usual. So I will keep you guys updated. It's 5:30. I got to go get ready for work. So look at this range. Look for it to react. But obviously, we are in the middle of this. I hate to say it, but like we look at this range here, right? And we just continue that over here. And we're basically in it, right? Like this has been stagnant. This was stagnant for a month. I don't want to be all negative Nancy with you guys, but right now, my options are to trade the range, pay myself early, dip, dive, duck, dip, duck, dive, ditch, in and out like a good Boy Scout, right? Nothing too bearish, okay? Nothing too bearish. Right now, my range is here. Very simple, right? I can throw on all the other TA, but right now, it's not completely relevant, right? It's not completely relevant. We don't need to confuse us all. We are looking for price to come up to certain levels. We have key levels above us. Make sure to add them to your charts. We have another golden pocket above us here that we can look for a trade at 29.1. Okay, Nick and I were talking about this. At 29.1, if we pull a beautiful, beautiful fib, we got 29.1 here. Be looking for that reaction, right? Looking for that reaction with some good risk management. That's one of the trades I'll be looking to take if it does come up and give me some sort of divergence, some sort of exhaustion. That can be nice around 29.1. Obviously, we have the top of the range here that we're looking to trade. Look for a reaction as well, right? We wait for price to get to a certain level and we look for a reaction, and that's how we'll trade this, right? So thank you so much, guys, for all your support. We got some good videos coming out. I think we got revenge trading. And we have how I do my setting up. And then we have fear, and then we have money flow, and then we have set it and forget it. And we have divergences, some market cipher stuff. So lots of stuff on the way. I've been doing a lot of recording in the background to get you guys some more videos to help you guys become profitable traders. So let's wait for a reaction. Right now, we're bouncing off VWAP, right? We're bouncing off VWAP. We're in this little downtrend. You can see here. Could be a flag, okay? Could be flagging out this way, right? So look for a reaction here. Look for it to continue downwards. If it does flip this, look for a bounce, okay? But just trade in the ranges, my friends. Just trade in the ranges, Power Rangers. Hope you're all doing well. I'm going to go and get ready for work. Thank you so much for all your kind, loving support. I will see you guys in the Discord. I will share my charts with you guys, and hopefully we'll get some more profits, my friends. Okay, so take care. God bless, and I'll see you guys in the next one. Bye. Oh, yeah, that's the washing rack. Yeah, and the skateboard. Peace out, guys. Love you. Bye.